Hello, everyone, and thank you for joining us. My name is Amanda Kramer, and I am the Alumni Engagement Program Manager at the University of Colorado Boulder's Leeds School of Business. These are certainly trying times, and we have gathered our world-renowned faculty and alumni to provide frank and timely insights for life during and after the COVID-19 pandemic. Today is the first webinar in our COVID-19 related webinar series. For this webinar, we're excited to have Professor Rich Wobbekind and Executive Director of the Business Research Division at Leeds, Brian Lewandowski, here presenting on COVID-19 economic discussion, what we know thus far. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask Rich and Brian, please send a question through the chat interface. We will monitor questions as they are submitted, and Rich and Brian will respond to them at the end of the presentation. As a reminder, for optimum audio quality, we do have everyone on mute except for myself and our speaker. If you experience any technical difficulties during the webinar, please notify us through the chat interface and one of our support specialists will touch base. Lastly, a link to access the webinar recording will be sent to all registrants tomorrow, along with the survey link and supplemental resources from today's presentation. Now, I would like to introduce today's speakers. Associate Professor Richard Wobbekind holds a PhD in economics from the University of Colorado Boulder and is, amongst many roles at the university, Executive Director of the Business Research Division at Leeds. He is a contributor to the National Association for Business Economics Economic Outlook and has been doing the Colorado Economic Forecast for over 30 years. Rich is joined today by Brian Lewandowski, Fellow Executive Director of the Business Research Division at Leeds. Brian specializes in economic and revenue forecasts, policy studies, and economic impact analyses. Welcome, Rich and Brian, and thank you so much for being here. I'm going to hand the controls over to you now, Rich.
Thank you, Amanda, and this is Rich Wobbekind. It's a pleasure to be with you, and thanks so many of you for joining us today. Needless to say, as this COVID pandemic has grown in size and economic proportion as well as human proportions, we've been inundated with a lot of questions about the economy and where the world is going. And because of that, we decided we would do this particular seminar. Notice that the title is called the Economic Discussion, not an economic forecast. As we go along, we'll describe a little bit more about that. But what we've learned so far, what kinds of scenarios are we looking at, and what kinds of economic, at least, damage and support is out there on the horizon. Co-presenting with me, as mentioned, is my colleague, Brian. He has done a lot of work on forecast scenarios with our colleague, Dr. Robert McNown. So when we get to his section, which will be the Colorado section in the second part of the presentation, we'll talk about a little bit of the work he's been doing in that area, again, with Professor McNown. And we should have ample time. We think it'll take us 30 to 40 minutes to go through our slides. We should have ample time, as Amanda mentioned, for a question and answer via the chat channel. You will see a little bit of what looks like glitches. We're following the governor's orders, and we are in 4 different locations as we're doing this. So bear with us with any minor technical difficulties you may experience. When we're looking at this, of course, I made the mistake of saying in one of my presentations that the economy was on really sound footing and the only thing that could really affect us was a black swan. And many of you who have finance or economic backgrounds know the sort of history of the black swan. These are the unforeseen events that you can't really know that are out there, but when they happen, obviously they can have a sort of catastrophic impact. And as we were looking at our forecast back in December, of course, there wasn't even really any serious sort of coronavirus on the horizon. We were talking about the forecast in January. We were trying to talk about the impacts on the supply chain from China. But as this has accelerated and grown in the US, it's obviously become a much more serious issue. We try to model things like this. It's a real challenge. We've been talking to a lot of fellow economists, different people who work in different agencies in the state and different communities in the state. Been trying to sort of think through this. And you hear very often sort of the analogy of, well, it's sort of like a hurricane, like Hurricane Katrina, but for the whole country. Like some sort of catastrophic event that shut down all of business sort of very quickly. At the same time, you saw all this business disappearing. And I do think it has sort of similarities to that. When we talk about what's happening in the overall picture, we have had a lot of industries shut down, not all of them, but we've had a lot of businesses shut down. But unlike a hurricane or a natural disaster, the physical infrastructure in the economy is still in place. We still have the restaurant space, just not operating the restaurant. We still have the retail space. We still have the gyms that people used to go to. So all of the physical space is still there. It doesn't need to be rebuilt. What we really have to focus on, and what we're thinking very heavily about, is how do you keep the business infrastructure and the government infrastructure in place so that this leads to a road that maximizes the road to recovery in terms of the overall macroeconomy recovery. So how long does the shutdown last? This is an interesting question, and one that we'd like to sort of address in more detail in a moment. So the overview of our presentation today is exponential growth in domestic cases. We're talking here about the virus. The whole point being the economy was on a very strong footing prior to COVID-19, and we'll show some illustrations of that. And unfortunately, because of each economic data lags, we know the impacts exist, but we don't have all the data to support how dramatic some of these impacts have been. Certainly, we believe that the federal policies will help mitigate the impact, at least the economic impact, and I want to make that point a little bit more detail a little bit further along in the presentation. Talk a little bit about the select industries that are bearing the initial brunt, and particularly as that relates to Colorado in the second part of the presentation with Brian, where he will talk about also the Colorado economy being on a particularly strong footing pre-crisis, the fact that we are overexposed to some of the economic downturn, but also that we are well positioned in other areas. So we'll give a kind of a sense of the Colorado economy in the context of what's going on nationally. So you've all heard this, and this is not intended to be an alarmist presentation. We're trying to be very factual, what we actually know, because watching the news can get upsetting, at least for me, watching and hearing all of these different things. But one thing is clear, the US has moved into the #1 slot in terms of COVID, and has really, grown dramatically and in a relatively short period of time, as we'll illustrate here in a moment. And that has, of course, led to a lot of the economic slowdown that we're hearing about. We knew about this in China, and we knew about this in other places. And so it's a little disconcerting that we were maybe a little slow on the switch in terms of addressing some of these issues. But we can talk more about that in the Q&A or other parts of the presentation. So here's Colorado with, as you can see, a darker color, one of the larger case numbers, not like the upper Midwest and certainly not like New York. And this is not adjusted for population. This is just the actual number of cases as of yesterday. And there was grave concern, and the governor jumped in, as you all know, and really did I think a very commendable job personally. But in any case, we've had this thing where it had been accelerating, and now we're seeing potentially a little bit of a slowdown. So I'll talk a little bit more about that in a moment. But what I want you to think about looking at this slide is, when do we defeat the virus? How does that happen? Because that's all about how the economy is going to recover. You can look at the Chinese economy. It's already in recovery. Their Q2 GDP numbers are likely to be positive. They're going to see positive growth over the next quarter, while much of the rest of the world, and especially Europe and the US, are going to see significant negative growth in GDP in the next quarter. So they were able to, get it back on a path. They had very stringent controls, as we know, and we kind of have read about these things following the virus. But based on China's time schedule, we would be getting back, if we applied their time schedule to the US, we'd be getting back on sound footing with business reopening sort of in general in sort of mid-April, and then public places and sort of those types of businesses, restaurants and so on, being something more like, say, the beginning of May. But can we match China's economic recovery speed? And I think the predominance of people who are looking at this think it's not likely that we will be on the same recovery path or as quick a recovery path as China. So you say why? One is, of course, we've taken a less stringent approach. The virus, therefore, lasts longer. We are a free country. We are not easily told what to do as people. So there are reasons for this. This is not something that's just totally crazy, that we just not as comfortable maybe with some of the things that are guidelines and rules. But we're also much more geographically diverse in terms of where these places are, and we have different situations. And then on top of all of that, we allow population mobility at a very, very high level. Again, focusing on Colorado, we know some of the cases came in from all over the globe, all other parts of the country. So you see that kind of population mobility making tracking this thing down, and even in the short term sort of solution, being a little bit more, taking a little bit more time perhaps than China. So if you put that all together, I think you come up with a conclusion that mid-April to May turns into sort of mid-May until June, pretty much sort of the timelines you're seeing for things like Major League Baseball going back and playing games. They're suggesting something around a June timeline. So that seems to be where we're aiming in terms of getting the economy back and getting those sort of functions back. Again, this is so dependent on whether or not we see control of the virus, the so-called flattening of the curve. And so you can see this, and it's particularly heartening. One thing, of course, you can see is that Colorado was in this game earlier than much of the rest of the country. But you can also see in the tan line the fact that Colorado appears to be, at least over the last few days, this is daily data, appears to be increasing, but at a decreasing rate. Not increasing at an increasing rate, which the red line of the US seems to have adopted. Now, just this morning, the governor came out and said that now our cases are doubling every 5 days. They work doubling every 2 days, making the case that, in fact, what we're doing is working, and that's very comforting. I've also heard there's other parts of the country that are also seeing some similar results, although I have not been able to track down that information yet. So hopefully we are sort of getting a handle on this, and we are going to be able to sort of get this thing to slow down and get us through at least the first wave of the damage. Again, highlighting the fact that when we look at this, we're looking at the overall picture of where we were and how healthy the economy was. You can see that potential GDP may not be really easy to see, but going into this, potential GDP, which is the blue line, was actually higher, real GDP was actually higher than potential GDP, which is the red line. So we were really, the economy was basically running on all cylinders. We saw that with unemployment rates and other indicators I'm going to be putting up here. And you can sort of see the longer term trend going out in the future that was forecast before the coronavirus had such a big impact. So this is what we're sort of looking at now, and there's some slides a little bit later on in the presentation that highlight this in a little bit more detail. But pretty much, if you look in that upper right-hand corner, you have a blow-up, if you will, of what we're looking at for the next, for this year and next year, 2020 and 2021. And what we're looking at in that upper right-hand corner is a growth that would be negative in Q1, but not hugely negative, and that's of course ending today. This is the end of Q1. A dramatic drop in Q2, and then recovering a not as dramatic drop in Q3, and then going positive in Q4. There are a wide variety of forecasts in this area, and there are some forecasts that have a lot more rapid growth, if you will, in the third quarter, closer to zero or even at zero. So not as bad a third quarter. And it really seems, again, pretty concentrated in terms of the negative GDP growth in the second quarter. But this is dramatic negative GDP growth and shouldn't be underestimated. We're talking 25%, 20%, 25%, 30% negative GDP growth in one quarter, just based on all of what we're losing in April and likely in a chunk of May as well. Then the question becomes, of course, how quickly do the consumption patterns return, and are the businesses still in place to hire back the employees who have been laid off? May not be too easy to see, but then out in 2021, we see a recovery up in the sort of 3% plus range in terms of capturing some of that growth back that has been lost in the 2020 timeframe. Again, this is looking at national employment, and you can see the dramatic drop, pretty consistent with what happened in the Great Recession, but not lasting nearly as long. You go back and look at the 2008, you're talking about continuing employment losses all the way well into 2010, a much bigger time frame. And here you're talking about jobs sort of breaking even in terms of netting out to zero by the end of 2021. You're starting to see, by the end of 2020, you're starting to see that. Again, in the blow up in the upper right-hand corner, you see various scenarios that we have taken from Moody's to show differing sort of patterns of recovery. But this appears to be sort of the scenario seems to be what we're thinking about. So the employment effect, dramatic earlier, and takes a longer time to recover in terms of those jobs coming back than the GDP numbers, which are output based. Overall, labor underutilization and labor use, you can see again going into this, unemployment 3.5% in last month's release, and U6, the underutilized labor, at 7%. That's the lowest number ever for U6, and it's the lowest number in 40 years for U3. So we're clearly seeing the an incredibly strong labor economy and a very tight labor economy going into this. And that's one hope in terms of coming out of this. We were in such great shape going in. If we can hold on to the business infrastructure, maybe the road to recovery will be a little bit smoother going in. So this slide highlights, again, what we're talking about a moment ago in terms of how deep some of these forecasts are for the second quarter, highlighting two things on this slide. One is at the bottom, it says as of, and it's the date. And everybody, a lot of these forecasts are coming out weekly. And so every time they come out, they have been tended to be revising down as we've gotten more economic information, macro information to build this on. As you see more and more of that information coming out, then you start to see a situation where that's being built in, and that's showing the overall impact on the economy to be more severe than previously thought. So you can see at this, we're talking the second quarter GDPs for any of the ones that came out in March. You see almost everything that's come out in March. You see -15, -24, -25. There are others that are out there that are -35. We don't have every single forecast up here. The only one that looks kind of healthy is the Congressional Budget Office, and that came out at the beginning of January. So it really doesn't incorporate any of this corona impact in the US. So this just slide shows you sort of the past recessions and how long peak to trough, how long it took, and then also how long it took with the recovery. And you can see more recently, since the 81, 82 recession, the recoveries have been more jobless in nature. And so we have seen they've been longer in terms of the recovery, in terms of the number of months to recovery. And of course, the most recent one, the The Great Recession of 2007, 2008, went into early 2009. We see that took a tremendous amount of time to get all the way back to the employment recovery. Not thinking along the same lines with this one. We're thinking a much, the peak to trough on the left-hand side will be fairly significant and maybe even larger than the -6%, probably larger than the -6% of the 07-09 recession. But the right-hand side should be dramatically shorter in terms of months to recovery. This is probably the most shocking slide in the deck, and you probably saw this in the newspaper, so I don't need to sort of go crazy about this, but this was the initial jobless claims. They had been hovering around 200,000 per week for a really, really long time, and very, very healthy and very low numbers. And you can see even in the recession, they went up to 500, 600,000 a week, but for many weeks in a row. All of a sudden, we went from 200,000 to 3,283,000 in 1 week. So we're seeing this incredible dramatic effect of the shuttering of businesses around the country and sending people home. More about that in a moment as we go forward. So consumer confidence, the most recent readings, we got consumer confidence this morning and consumer sentiment last week from Michigan. We are seeing fairly steep declines in terms of monthly declines. Still overall, they're in better shape than you would say. I mean, they're still pretty far up in terms of how pessimistic people got and really bad times are in the recessions. But they have seen a fairly dramatic drop. Consumers have continued to be more optimistic in general than businesses are, and they have been for a really long time. And this is, of course, extremely important because their optimism leads to consumption. Consumption leads to the recovery. And if consumers stop buying completely, obviously they're cutting back a lot right now. If they stop buying completely, that's going to exacerbate the recovery of retail, of restaurants, and of other things. Again, you can see the ISM index, not particularly bad, the manufacturing index and the non-manufacturing index still in positive territory. We'll see with the next month's release, which is a couple of weeks out, if there's much of an adjustment to that. What we have seen is the state by state or region by region indices in manufacturing. A number of them have had significantly negative readings. Empire, as you might guess, is the New York State Manufacturing Index. Kansas City Fed Manufacturing Index, which came out last Thursday, is on the right-hand side of the slide. And you can see that plunged to -17. This, of course, is the Kansas City Fed district, so we're part of that. But actually, concentration of manufacturing is larger in several of the other states that the Kansas City Fed operates in than it is in Colorado. Nonetheless, they saw a lot of negative comments. Over 70% of the survey respondents mentioned the coronavirus as very damaging to their business. So again, on this sort of theme of the consumer dropping back for a moment, I mentioned consumer confidence. Of course, another thing is not just the income loss, but the wealth issues that are related to the dramatic drop off in the stock market. One of the things that, of course, is interesting to see on this slide, this is only tracking the last year. So at this point, after that dramatic bear market we've been experiencing, and now some recovery of that, some bounce back, you can see the NASDAQ is actually exactly where it was a year ago. So we had this incredible run up during 2019. We now see this, significant drop off. And some of the other indices, obviously, the Russell 2000, which is a small business, includes more small businesses or medium, I shouldn't say small, but medium-sized businesses. The Russell 2000, which is a much broader index of companies in the economy, has not come back. It's at 25%, down 25% in value from where it was at the beginning of March last year. So it varies a little bit, but you are seeing at least some bounce back there. And again, this is going to be critical for consumers once the recovery begins, consumers feeling good about being able to go out and spend and to go and enjoy the things that they used to do. Coming sort of to the end here, let me just make a couple of last comments. Interest rates should help in terms of both mortgage refis or mortgage keeping mortgages at very, very affordable rates, short-term loans, car loans, and so on, with interest rates so low, should continue to be a support for the consumption side of the economy. So if people are in a position to purchase things, they are going to get very, very attractive interest rates. And that's, again, one of the sort of positive upsides. This slide is we're estimating the budget balance this year is going to be over $3 trillion of loss of deficit, and it will take the deficit to GDP ratio up to 14%. It also moves up by 10 years. The time it's going to be debt to GDP ratio is going to get to 100%. It's going to come up in the not too distant future now because of the dramatic amount of spending that we're going to be doing in 2020. There will be a fiscal day of reckoning, but right now we're focused on what's going to happen in the next year to 2 years, get the economy back on track before we really focus on the fiscal day of reckoning. So one thing I would like to highlight in my closing comments here are, since I'm watching the time, trying to watch the time carefully, visualization of the CARES Act. I would draw your attention to this slide produced by CRFB. They really show a lot of where the money, what it's listed as, and then who ultimately will be the recipient on the right-hand side. Very importantly, I want to highlight, large business, small business, households, 610 million to the households, but also down below, state and municipalities will be getting money, as well as airline industry and so on. A couple of highlights of this. Clearly, the unemployment insurance bump is huge in terms of what it does for the economy. It adding $600 a week to the unemployment benefits. That's higher than any state gives in a week. Massachusetts is the highest amount, and it's $546 a week. So this is going to be more than doubling the amount of money people in unemployment insurance are getting. And so it should give them enough income to keep them going in these very trying times. It was expanded to people who are sole proprietors or part of the gig economy, not just people who are on payrolls and paying into unemployment insurance. So it was given a more expansive piece, and that was important. We also are seeing $1,200 a person in direct payments in terms of checks going to be written by the government, at least as reported within the next 3 weeks. We're going to see those checks. It does get phased out for higher income individuals, but many people in the country, like 90% of the people, are going to be receiving some amount of money from the federal government in direct payments. So you can see all of those. And then very interestingly, in the loan category, the creation of the Federal Reserve special loan piece that's in there, the Federal Reserve is going to get $475 billion that it's going to use to back $4.7 trillion of loans to businesses, state governments, and local governments. So this is unprecedented, and I can't say enough positive about the coordination of fiscal and monetary policy. The jumping in on this is the one biggest hope we have for a more rapid recovery. There's more details on this slide, and I need to get to my colleague Brian, so I'm just going to close by saying he'll talk to you a little bit more about the sectors that get the most impact in Colorado. But when you look at these major employers in the country, trade, transportation, and utilities is where retail is. Education and health services, private education is in there, and we know there's some impact there. We do think there'll be some impact in government. And then, of course, leisure and hospitality is taking a huge brunt. including accommodations and food services. So these are major national employment groups, and that's why we're paying so much attention to this. So with that, I'm going to pass the torch to my colleague, Brian. I apologize for talking a little longer than anticipated, but take it away, Brian.
So thanks again, Rich, for your comments. Now, for my section of the presentation, I'm relating the story to what we currently observe in Colorado and some of our expectations in Colorado. So if you've heard Rich or me speak over the last few months after our December forecast, the story that we've continued to say is that Colorado still has a really strong economy. We've been among the leading economies coming out of the Great Recession, and the underpinnings of our economy really showed very few signs of cracking. So when we think about the basket of economic metrics, if we think about employment or GDP growth or personal income growth and wage growth, low unemployment rates, low foreclosure rates, labor force growth, labor force participation, the basket of these economic metrics really point to a really strong economy. So at the same time, we've been saying that Colorado's economy has been growing but slowing. But as this slide shows, our ranking among the 50 states, we are still a leader. So really we're slowing relative to ourselves, relative to where we've been. But we were still a leading economy nationally. Of course, this was true as we led up to the current events. When we've talked with businesses over the last year, 2 years, 3 years, they have perpetually been telling us that it's a tight labor market. They're having a hard time finding workers. When we take a look at Colorado's unemployment rate, even that was just reported for February, these are historically low levels. We've never seen lower unemployment rates in Colorado than we have now. Nationally, we haven't seen lower unemployment rates than since the late 60s. The labor utilization rate, or the rate of underemployment, is at the lowest rate in its series that goes back to 1994. So it shows that the labor market has been very tight. Nationally, we saw strong job growth both in January and February. And when we take a look at other economic metrics, even for instance, pointing to DIA, Denver International Airport traffic, so enplanements and deplanements, January recorded another record level. We saw January grow 5.8% year over year. We saw the last 12 months grow 7.1% over the prior 12 months. So fundamentally, all of the economic data, federal data, state data, pointed to pretty strong underpinnings in the economy. Of course, as we're looking for evidence of the current situation, we can point to the Leeds Business Confidence Index that was just released today. So since 2003, the Leeds School of Business has conducted this survey of Colorado business leaders, and we asked 6 questions about the economy. We asked business leaders their expectations for the national economy and the state economy, sales, profits, capital expenditures, and hiring, and we wrap all of these metrics into a single indice, which is on your screen now. And this is our expectation 1 quarter out and then 2 quarters out. And we look at this as a good leading indicator. And what we learned this quarter is, as expected, confidence really took a deep dive. This is the worst fall in confidence that we've seen in the history of the survey. It's also the lowest level that we have observed in the survey, even just slightly below what we saw during the Great Recession. And I think what's notable about this quarter's confidence index is that, compared to the Great Recession, is that we saw really the economy performing well. We saw business leader optimism holding up okay over the last 8 quarters or so in the face of a lot of uncertainty in the marketplace with tariffs and trade wars and impeachment and other factors. But this event caused confidence to really walk off a cliff much faster than what we saw during the Great Recession. So I think during the Great Recession, what we saw was confidence fall and then stabilize, and then this realization of how long and how deep that recession was, that it ended up taking a second dive. What we saw is confidence really get wiped away very, very quickly this quarter during the survey period. The other thing that struck me in this quarter's confidence index is that when we asked about 2 quarters out, business leaders indicated less pessimism. I'm hesitant to say more optimism because they're still clearly pessimistic, but there's a sign here that they expect the 3rd quarter to be better than the 2nd quarter. And I think that aligns well with what we hear from the president and the governor and other public officials that indicate hopefully an opening of our economy in May, June, July, when we start to see restaurants open back up again and other institutions open up, so we can start to get back to some sort of normal daily life, and that'll have a positive impact on business. So the economic data that we've looked at so far, I mean, the employment report for the states came out earlier this week for February, and that still showed strong job growth for Colorado. We still saw the historically low level of unemployment. Nationally, we saw January and February's reports very strong. We'll get another jobs report on Friday, which will be the first indication of the job losses by industry. The initial jobless claims is really one of the early economic metrics that we have that point to the economic situation that we are currently in. So this is a good leading indicator for the economy, because as we lose our jobs, as we get laid off, this is one of the first actions that we take to go and register for unemployment benefits as a way of, shoring up our households to make sure our households at least have some income coming in. So this spike that we saw is really a prelude of so many other economic metrics that we expect to deteriorate over the next month or 2. I think it's really notable looking back through this entire history of initial jobless claims for Colorado at just how different this spike in initial claims is. It's truly unprecedented. And I mean, it's almost frustrating making some of these slides now, knowing that we have to rescale everything and just to accommodate all of these economic records that will be broken over the next month or 2. Colorado employment, we've really been on a tear since the Great Recession. We think about job growth in Colorado and compare it to the nation, and we have really been the 3rd best state in terms of the jobs recovery from the last recession. We were behind states like Utah and Texas in overall job growth from the prior peak. And like the nation, you can see that we've been on a growing but slowing trend. We revised our 2020 number from December. And in December, we were expecting to add about 40,100 jobs in 2020. We expected it to be the slowest rate of growth since 2011, slowest number of jobs added. And now we have an early model that is projecting job losses for the state for the year. This is a very early forecast, but we have it at minus 70,000 jobs right now. But as more of this economic data comes out, we'll continue to revise this. Part of the problem when we're doing our economic models is if we start with this expectation about negative GDP growth for the quarter of minus 15% or minus 20% or minus 30%, we can run those expectations through our models, but it doesn't necessarily take into account some of our over-concentrations in certain distressed areas or over-concentrations in areas of strength within our economy, which I'll talk about in just a So when we think about job losses, just to give this some sort of perspective, we saw strong wage growth year over year in Colorado. Wages grew on average 4.9% over the year in the third quarter of 2019. And average wages in Colorado now are $61,200. Okay. So then if you think about the other side of that ledger with job losses, if we're expecting 70,000 jobs lost in 2020, what does that mean in terms of total consumption power? So for a little bit of perspective, we expect to lose about $1 billion in total wages for every 16,000 jobs lost. That's just assuming the average wage in Colorado. I think what's kind of interesting about the situation that we're in, though, is that we aren't losing the average job in Colorado. When we take a look at this slide, this is showing you the gray bar in the middle is showing you the total number of jobs in the state. So we have 2.7 million jobs, and the average wage is $61,200. Okay, everything above that bar are industries that pay above average wages, and everything below that bar are industries that pay below average wages. But really, the front line of this crisis has been the tourism industry. So think about arts, entertainment, and recreation. So these are ski resorts. These are our NBA teams and NHL teams and other forms of entertainment. It's also retail trade. It's hotels. It's restaurants. And incidentally, those are the three lowest paying industries within our economy. I mean, this data is partially impacted because average wages are really calculated based on a head count, so it's not adjusted for a full-time equivalency. So we know a lot of retail jobs and restaurant jobs tend to be part-time, which is partially why it shows lower than average wages. But nonetheless, we also know that a lot of these tend to be minimum wage or just above minimum wage type jobs. So our lowest wage industries have been the hardest hit so far. This is true. One piece of evidence is if we take a look at the WARN notices that the state publishes, it's a lot of our ski industry, restaurants, retailers, car dealerships that are doing the early mass layoffs. And they cite them as temporary closures with this expectation that they do plan to come back after this event. So if we think about retail for a moment, 272,000 jobs. If all of retail shut down for 2 months, and then all of retail came back for the rest of the year, then that would equate to about a 16% loss of retail employment, right? So with 2/12 of employment activity for the year. So much of this will depend on the duration of the closures, the duration of this downturn, how quickly restaurants and retail can open back up, and then also longer term expectations about some sort of double dip crisis, whether we see the virus come back this fall or not. So the main industries that we see being impacted, again, are trade, transportation, and utilities. So we've certainly seen this in the retail trade area, except for grocery stores. We've seen this in terms of public transportation and also airline transportation be dramatically affected. But also notice that this is total number of jobs in Colorado. This is our largest industry in Colorado. The other major industry that's being impacted is leisure and hospitality. So I mentioned this as far as arts, entertainment, and recreation type activities, restaurants, and hotels. And the other industry that's being impacted pretty severely right now is natural resources and mining because of the sharp downturn in oil and gas prices, which I'll talk about in just a moment. So these three red bars indicate the three industries that we expect are under greatest pressure right now. But secondary impacts are impacting government right now. We've seen a decrease in, or we expect to see a sharp decrease in tax revenue, so sales taxes and income taxes, just to name a couple. And education and health services. So education, on the private education side, this includes private K-12 schools, private higher education, but it also includes gymnastics and dance studios and driver's education type businesses. On the health services side, we've seen closures, temporary closures of dental offices and orthodontist offices. We've also seen a lot of general practitioners close, except for real emergency visits. So healthcare is interesting because they're the front line of the health crisis, and we've certainly seen a lot of activity on that side, but there's also a side of healthcare that's gone a little bit dormant in the short term. Leisure and hospitality, not to keep reiterating this, but we do think this is the front line of the economic downturn. And this shows you the percentage of leisure and hospitality employment by county in Colorado. So this is each county's share of employment that's devoted to leisure and hospitality. The darkest counties like Grand County, Summit County, Gilpin, and Mineral County, they have the highest percentage of their employment that's devoted to these leisure and hospitality activities. So that the lighter the shading here, the least amount of activity they have in tourism overall. So arts, entertainment, and recreation includes activities like ski, golf, fitness centers. So think about your gyms, think about bowling, think about casinos and museums. Accommodation and food services are hotels, restaurants, and bars. Some of these mountain resort counties have 40% plus of their total employment nestled in this one industry. And when we've done resiliency studies over time, we've noted that the less diverse your economy is, the more susceptible you are to economic booms and busts. So we've often talked about this in relation to natural resources like coal, oil and gas, or agriculture that are very dependent on commodity prices and boom and bust cycles. But we've also noted this in the past when it comes to tourism. We've observed this throughout history that tourism communities are also susceptible to that boom and bust, not only in terms of employment, wages, and housing prices, but even things like population growth, net migration. So often what we can see during recessions is a net out migration from mountain resort communities, and during boom times we see a net in migration. And that makes sense. If your jobs go away within the leisure and hospitality sector, you often have to leave town in order to find another job opportunity, hence why we see that type of migration. Leisure and hospitality is, this is showing some of the prior booms and busts, looking at the impact from the 2000-2001 recession. You can see that leisure and hospitality overall lost 3.1% of employment in Colorado. The Great Recession caused 6.5% of employment to evaporate, and it took years to recover that employment within the industry. Leading right up to this current situation, we saw continued growth in leisure and hospitality statewide, both in hotels and restaurants, as well as in arts, entertainment, and recreation. But we expect this to be a steeper fall very quickly within these two sectors within the state. And casinos are a very good example, unfortunate example of this. We have 3 casino communities in Colorado: Black Hawk, Cripple Creek, and Central City. And we know that this is one of the areas that have been shut down statewide. But to provide you with a little bit of perspective, this industry records over $800 million in gross proceeds every year. So a 1 month or 2 month interruption within this activity will have pretty profound impacts on these 3 casino towns. That really this is the only industry within these 3 communities. When we think about the oil and gas industry, this is showing you the WTI spot oil price on the left axis, the black line, and then the Colorado rotary rig count, which is represented on the right axis and in the gold line. And you can see that these are both volatile series over time. But to paint you just a general picture, when oil prices fall sharply, we see somewhat of a short delay before we see a fall in the rig count. And then there's another delay before we see a decrease in employment. And then a long delay before we see a decrease in overall oil production within the state. But the sharp decrease that we've seen in the WTI spot price really portends a coming decline in the industry that's already played out in the news headlines in Colorado with some of our oil and gas producers in the state. Overall, what we're observing now is the WTI spot price has fallen below $20 a barrel, which is certainly below the break-even price for almost all of our oil producers within the state. One benefit of the fall in oil prices is the benefit to the consumer. So we're seeing gasoline prices fall to levels that we haven't seen in years since 2016. So there's a little bit of a cost savings to consumers. Of course, how many cars are you seeing on the road right now? The fall in oil prices has been a result of a price war between the Middle East and Russia, as well as an evaporation in much of the demand globally for oil. And we are seeing that in lower retail gasoline prices. A couple of the fiscal impacts that we're observing. We're seeing a flattening in Colorado's general fund. The Office of State Planning and Budgeting and Colorado Legislative Council both came out with their March reports about a week ago, and both institutions revised down their expectations for Colorado's general fund, citing lower than expected retail sales and income tax revenue. And they ranged between minus hundreds of millions to minus $1 billion that are expected over the next 2 years. So that the state legislators will have to grapple with how to balance that budget in very short order. But the other thing that you need to remember is while we do expect a sharp decrease in sales taxes from this event, only part of that is really borne by the state. Colorado has a very disaggregated tax structure. So the state only gets 2.9%, but we see the average sales tax rate among Colorado communities over 7% because a lot of that sales taxes goes to support city or municipal government. So actually 60% of general sales tax revenues go to local cities and counties. So that's where the CARES Act at the federal level will help backfill some of these losses that we really expect to see for cities and counties as well as states. So just to summarize this Colorado section, yes, we do look back at Colorado as being on a pretty strong footing prior to the COVID-19 outbreak. We do see tourism on the front line of this economic downturn, and unfortunately, we do see the mountain resort communities being less diversified and heavily weighted in the tourism industry as bearing a pretty high cost to this downturn. But we also do see an impact on the oil communities in Colorado, particularly Weld County, which produces about 90% of the oil that is extracted in Colorado. We do see this financial hit to state and local government. We expect that to also impact universities in the state. And we do see some optimism in there that the CARES Act will partially mitigate some of these factors. The one silver lining is that Colorado does have a high-tech underpinning to the economy. So we see a lot of professional and business services jobs within the state. We've been able to attract a lot of highly skilled, highly educated workers to Colorado to work in this tech economy. These are also very high paying jobs. And fortunately, these are a lot of jobs that can be done remotely. So a lot of people have been able to take this work home with them. And remember that a majority of Coloradans, as well as a majority of Americans, still do have their jobs, and they do tend to be the higher paying jobs. So we do expect there to be a lot of pent up demand for spending once the economy does get back on its feet. Lastly, our office, as well as many other people that we talk with at the other universities in the state and state government, are working on doing additional economic modeling. We'll have new estimates out over the coming weeks and coming months, and we'll be sure to convey that to you as they become available. So that's the end of my presentation. I'll turn it back to you, Amanda, to start sharing some of our questions.
Great, thank you, Brian. So it looks like we have time for a couple of questions. One question that's come in from Joanne is, how do your models break down GDP impacts?
Sure, so there's a couple ways that we've worked on it. And I described this a little bit during the presentation. So we tend to start with what's happening at the macroeconomic level, so what's happening nationally, and we relate those variables to the Colorado economy through some key variables like GDP or employment or personal income, sales taxes, population growth. And then we can even relate that to more localized communities like metropolitan areas. So the GDP component is a significant component for this. However, what I described during the presentation is a lot of those metrics are a little bit general, where we see the onset of this downturn being very focused on a few industries. And that's where we need to work on calibrating our models a little bit better to show that immediate impact, say, on the tourism industry, on restaurants, on hotels, on the ski industry, because we do have a disproportionately large tourism sector compared to the rest of the nation. So I think our early modeling estimates, where we take those generalized impacts, provide us kind of this first glimpse into the economic impact on the state, but it'll take more refinement to actually show the economic impact on each industry as we learn a little bit more from the federal and state economic statistics that will come out over the coming months.
Great. Thank you for that. One question from Neil. He wonders, has there been any modeling that looks at a situation in which there could be 3 or 4 waves of COVID-19?
So I haven't seen any modeling that's done 3 or 4 waves. I have seen modeling that basically shows a second wave coming back in the fall. That basically pushes the recovery back almost, it winds up with negative GDP in the third quarter and into the beginning of the first quarter of 2021, and pushes the recovery back out another year at the other end. I think most of this, and I'm guessing or hypothesizing, I think most of that relates to the fact that there's sort of some belief that there will be, in 18 months, there'll be a vaccine for this. So a lot of people don't want to sort of plan on it being here beyond 18 months. There's also a lot of people trying to estimate. There's companies like Sanofi and Regeneron and others that are using existing drugs to try to speed recoveries faster. So there's just a lot of unknowns that just can't really measure.
Okay. We'll do 2 more questions here, taking a look at the time. There's a question from Jordy for you, Rich. He wonders, what are the implications once GDP is equal to national debt?
Well, I just sort of tritely said the fiscal day of reckoning. You know, I think some other people were asking a similar sort of question as they were flying by on the side of the screen. You know, the country can support it. We have a very strong economy. People, you know, they love the dollar and they love our debt, and you have all those pieces. But sooner or later, given all the liquidity that's out there in the system that's now been added, you know, all of the additional balance sheet for the Fed and so on, I think you have to think sometime out in the horizon we're going to have higher interest rates in an inflationary environment. So the cost of servicing that debt's going to get more significant. We already knew the debt was increasing year by year based on current spending patterns, but also based on demographic change. So I think it's going to give the federal government, federal government's going to have to be spending a lot more of its budget on servicing the debt, and probably going to limit the amount of other things it can do.
Okay. Thank you, Rich. And we'll move to the final question now. This is from Alan. Could you speak to the impact on commercial and residential real estate markets, specifically within Colorado?
Can we? I don't know at this point. What we've seen preliminarily from the residential markets has not been particularly problematic, but I guess, you know, the question's going to become, and people have asked variations of this and some of the other questions. If people aren't paying their rents and so on, what's that going to do? I personally have more concern about that on the sort of commercial side, but a lot of the loans, the small business loans and the bigger business loans, but especially the small business loans, are pumping a lot of money to the small business sector so that they can pay their rents. So there seems to be some significant backstopping going on there. In terms of the residential side, I think we've been sort of thinking about this in a couple of ways. Will people stop paying their rents? Well, with the amount of money coming in unemployment insurance from the state and from the federal government, people should still be able to make their rent payments. So I don't think you're going to see people stop paying rent, or a lot of people stop paying rent if they're collecting the unemployment insurance. But we did have a thought about if people bought second homes in particular that they were using for VROB or you know, some other variation of rental, is that going to impact those types of properties? And we haven't come to a conclusion, but we certainly think that that's a potential that we're going to see sort of potential impacts on second homes.
We did see a CoStar report that came out today that showed some downward pressure on rents within the Denver metro region. And I looked at Zillow this morning, and they have a market temperature for Colorado, and it's now switched to quote unquote cool rather than hot. And you know, we've seen so much growth in home prices over the last decade. Some slower home price growth will be welcomed by some people within the state.
Great. Thank you so much, Rich and Brian. We will wrap up here. I want to say thank you so much to everyone for joining us for today's presentation, and a special thank you again to Rich and Brian for this great information. All webinar attendees will receive an email tomorrow with a link to the recording so that you may view this recording at any time, as well as a link to that Leeds Business Confidence Index that Brian referenced. To view upcoming webinars in our COVID-19 series, as well as previous recordings, please visit our website at colorado.edu/business/alumni. Our next COVID-19 webinar is on Thursday. We hope to see you then. In the meantime, have a great rest of your day, and go Buffs.